Welcome to Gold Bank.
Glad to be here.
If you're managing a UK portfolio right now, or even just keeping an eye on the broader financial landscape, you're probably noticing some major movement in the commodity sector.
You really can't miss it.
No, you can't. So we're walking through the recent rebound in precious metals today, which is heavily tied to the escalating geopolitical tensions in the Middle East.
Right.
Our goal is to look at what the data actually tells us, cut through the daily noise, and figure out exactly what this means for your investments.
Exactly.
We have a clear path laid out. First, we'll examine the headline price movements across gold, silver, and platinum.
The big three.
The big three, yeah. After that, we'll break down the specific mining companies emerging as clear winners in this high-price environment.
And we have to look at the other side, too.
We do. We'll follow that up with a look at the companies missing out on the rally, entirely the losers.
For UK investors who track mining shares, physical bullion, or exchange-traded funds, the numbers we're seeing right now provide a highly practical lesson.
A real-time lesson, really.
Yeah, we're watching in real time how quickly geopolitical events reprice defensive assets. When the global landscape shifts and uncertainty rises, capital naturally looks for a safe place to park.
And we are watching that mechanical rotation play out across the entire precious metals complex. Let's start right at the top with the headline numbers.
Okay.
Because the recent data for the precious metals rebound is, well, it's striking. Spot gold climbed 0.7% to $5,120.71 an ounce.
Which is a solid bump.
It is. But what stands out immediately is that this recovery comes directly on the heels of a drop of more than 4% in the previous trading session.
A huge drop.
Right. And U.S. gold futures also settled 0.2% higher at $5,134.70. A 4% drop followed by an immediate bounce for an asset as traditionally heavy and slow-moving as gold.
It's a massive amount of volatility.
It really is. So why are we seeing this kind of whiplash in the pricing?
The volatility really comes down to two main macroeconomic forces acting on the market at the exact same time. First, safe haven demand has returned quite sharply due to the escalating conflicts in the Middle East.
Right.
When uncertainty rises in that region, institutional capital and retail money traditionally flood back into gold. It's the ultimate defensive posture for a portfolio.
Sure.
But the second force pulling in the opposite direction is the U.S. dollar.
Wait, let me pause you there. If the dollar takes a breather or surges, why does that automatically dictate what gold does?
Break down the mechanic.
Yeah, break down that specific mechanic for me.
It comes down to purchasing power. Gold is priced globally in U.S. dollars.
Okay.
So when the dollar goes on a strong run and gains value against other currencies like the British pound or the euro, it takes more of those local currencies to buy a single ounce of gold.
Right, the exchange rate bites you.
Exactly. That effectively makes gold more expensive for non-U.S. buyers, which suppresses global demand and pulls the price down.
So that's what caused the initial 4% drop.
Spot on. However, the dollar finally paused its recent rally. When the dollar takes a breather, it gives precious metals room to recover because that currency pressure eases up.
So it's essentially a currency seesaw.
Yes, a seesaw.
The dollar pauses, the currency pressure lifts, and the metals immediately make their upward move based on the geopolitical fear.
You've got it.
And we're not just talking about gold here. The data shows spot silver rose 1.3% to $83.07 an ounce.
Yeah.
And spot platinum gained 2.8% to $2,141.71. Silver moving in tandem with gold makes logical sense.
Always does.
But platinum outpacing both of them by gaining nearly 3% in a single session, that is a massive jump. What's driving platinum so hard?
Well, platinum has a distinct structural story right now that separates it from gold and silver. It's not just benefiting from the defensive safe haven market behavior.
What's the structural piece?
The UK-based World Platinum Investment Council forecasts that the global platinum market is heading for its fourth consecutive annual deficit in 2026.
A 4-year deficit?
4 years in a row.
If we've been consuming more platinum than we actually pull out of the ground or recycle for 4 straight years, how is the market still functioning? Where is the extra metal even coming from to meet that demand?
That is the crucial question. When demand outstrips supply for that long, the market is forced to eat into above-ground stockpiles.
Ah, so they're raiding the vault.
Exactly. Those stockpiles act as a buffer, but they are finite. When you have a structural deficit stretching over 4 years, it gives platinum an outed layer of fundamental price support.
Because the market knows the buffer is shrinking.
Right. So when you combine that baseline supply tightness with a broader macroeconomic rally in all precious metals, you get that pronounced 2.8% jump. Platinum has its own unique engine driving the price alongside the broader safe haven momentum.
That paints a very clear picture of the underlying mechanics. Bringing in some outside analysis, Peter Grant from the US-based Zaner Metals noted that macro conditions remain highly supportive for these metals.
They definitely do.
But the volatility we discussed is likely to continue. He pointed out that ADP employment data out of the US is a key marker the market is tracking right now.
A very critical marker.
How should a UK investor connect those dots? Why should someone in London care about US payroll numbers when looking at their gold allocation?
If you hold a UK portfolio with exposure to bullion, ETFs, or mining shares, gold is acting as a classic defensive asset for you right now. It's doing the exact job it's supposed to do when global tensions rise.
But you can't just set it and forget it.
No, absolutely not. The immediate markers to watch are twofold. First, do the conflict risks in the Middle East stay elevated? If they do, that safe haven premium likely remains baked into the price.
And the second marker.
You have to watch that U.S. jobs data because it directly influences U.S. interest rates and the strength of the dollar.
Okay, walk me through that.
If U.S. jobs data comes in hot, the Federal Reserve might keep rates high, the dollar might strengthen again, and that could put downward pressure on gold.
Because of that currency seesaw we talked about.
Exactly. But if the data is weak, the dollar might soften further, giving metals even more runway to climb.
It requires a delicate balancing act. You have the geopolitical push driving fear on one side, and the macroeconomic pull of U.S. labor data driving the currency on the other.
It's a tug of war.
That perfectly sets the stage for the next part of our roadmap. Let's pivot to the companies actually pulling this metal out of the ground. Because when spot prices sit at $5,120 an ounce, you might assume every single mining company is celebrating.
You would think so, but no.
Right, that is not the reality. Let's look at the companies successfully capitalizing on this environment, the winners.
This is the exact point where the theoretical price of gold on a screen translates into actual tangible cash flow.
First up in the winners column is Fresnillo. Their numbers are remarkably robust. Their gold resources are up 14.3%.
A big jump.
And the reserves are up 7.4%. Those are huge leaps. But before we get into their earnings, can you clarify something?
Sure.
What is the actual accounting difference between a resource and a reserve in the mining world? And why does a higher gold price change those numbers?
It is a vital distinction. A resource is essentially the total amount of mineral in the ground that has reasonable prospects for eventual economic extraction.
It's what they know is down there.
Right. A reserve, however, is the specific portion of that resource that is legally and economically viable to mine right now.
So the reserve is the rock they can actually make a profit on today.
Yes. And this is where the gold price becomes magic for a mining company's balance sheet. When the price of gold goes up to $5,120 an ounce, dirt that was previously far too expensive to mine suddenly becomes profitable.
Oh, I see.
The cost to dig it up hasn't changed, but the selling price of the final product has soared. So a company's economically viable reserves literally grow simply because the math changes in their favor.
And Fresnillo is capturing that value beautifully. Higher prices have already lifted their profit and dividend profile, and they are experiencing a major earnings boost directly tied to these stronger precious metals prices.
They really are.
That is a phenomenal position to be in. Your inventory becomes more valuable without you having to discover a single new vein of gold.
Exactly.
Moving to our next winner, we have Endeavor Mining. The data points out that Endeavor saw its 2025 cash flow rise substantially. What's driving that pure cash generation?
Endeavor is a textbook example of a concept called operational leverage. When a large producer has meaningful output and their existing infrastructure is already fully built and operating smoothly, they can easily convert these higher realized gold prices directly into free cash flow.
Help me visualize that. If I own a bakery, my fixed costs are my ovens, my rent, and my staff.
Right.
Once I sell enough bread to cover those costs, every extra loaf I sell is mostly pure profit. Is a gold mine operating on that same basic principle?
It is the exact same principle, just on a multi-billion-dollar scale. Endeavor's fixed costs, the massive haul trucks, the processing mills, the workforce they're already accounted for, and running efficiently.
They don't have to build a brand new mine to capture the high gold price.
No, they just keep running their existing infrastructure. So when the spot price of the commodity rises well over those fixed operating costs, every extra dollar of price increase falls almost entirely to the bottom line.
Their cash flow naturally expands.
Right. Endeavor is positioned exactly where a miner wants to be during a prolonged price rally.
Let's talk about Pan-African Resources because their inclusion in the winner's circle is a bit different. The data notes their specific fiscal year 2026 production guidance, which they've pegged tightly at 275,000 to 292,000 ounces.
Yes, very specific numbers.
Why does simply issuing a production target make them a winner right now?
It comes entirely down to market confidence. Pan-African Resources is well placed because they offer direct gold price leverage combined with supreme reliability.
Reliability is key.
It is. Producers that offer fresh, stable, and transparent output guidance tend to benefit the most when the wider market decides to re-rate the mining sector based on stronger bullion sentiment.
Let's unpack re-rate. You mean investors are willing to pay a higher valuation multiple for the company's stock because they actually trust the math behind the future earnings?
That is the core of it. When gold prices sit at record highs, investors rush to buy mining stocks to capture that upside. But institutional capital demands certainty.
They want ironclad assurance that the company will actually dig the gold out of the ground to sell at those high prices.
Exactly. Because Pan-African Resources is offering very clear, fresh guidance of up to 292,000 ounces, investors can confidently model out the future earnings.
That stability, combined with direct exposure to the high gold price, makes them a highly attractive asset. Wall Street and the City of London reward predictability.
Predictability pays off.
Which perfectly illustrates the flip side of the coin. Because what happens when a company fails to provide that certainty? Or worse, completely fails to dig the gold out of the ground when prices are at record highs?
That's the painful part.
Let's shift our focus to the companies struggling to monetize the current price strength, the losers.
This introduces the most crucial risk factor for anyone holding mining shares. A sky-high spot price on a trading terminal means absolutely nothing if your operations are stalled.
And that brings us to Barrick Mining. The details here show a stark production drop. Mali's industrial gold output fell 22.9% in 2025.
A massive drop.
What exactly is happening on the ground there to cause a drop of nearly a quarter of the country's output?
The data points to a very clear operational roadblock. This 22.9% drop in Mali's output was largely due to the prolonged suspension of Barrick's Loulo-Gounkoto complex. It is a classic, albeit painful, lesson in jurisdictional risk. It serves as a stark reminder that even with gold prices sitting at highly favorable levels, operational and political disruptions will absolutely stop a producer from fully benefiting.
So as an investor sitting in the UK holding these shares, you aren't just betting on the global gold price or the company's engineering skills. You're heavily betting on the local political and regulatory climate of a jurisdiction thousands of miles away.
You are inherently taking on that risk, yes. And a prolonged suspension is incredibly costly.
Because of the carrying costs.
Exactly. It's not just about missing out on revenue. A suspended mine still has massive carrying costs. You have equipment sitting idle, you have security and maintenance teams that must be paid, and you have infrastructure that needs upkeep even when no rock is moving.
So they're burning cash while making nothing.
Right. Barrick is a massive, experienced operator. But a prolonged suspension at a major complex like Loulo-Gounkoto creates a severe drag on their ability to capture the upside of $5,120 gold price.
They simply cannot monetize what they are not allowed to mine.
Spot on.
That is a massive operational hurdle. But the roadblocks aren't always about regulatory or political disputes. Sometimes the hurdle is just Mother Nature.
Very true.
Our second company in the losers category is Freeport-McMoRan. The data shares a phenomenal production hit at their Grasberg operation, where gold output dropped by about 85%.
It's hard to overstate that.
An 85% drop for a major operator is staggering.
It is an immense reduction in output for one of the most prolific mining assets in the world. To clarify the underlying issue, this massive drop was tied to severe flooding-related disruption in 2025.
Walk us through the reality of that. When a mine the size of Grasberg floods, what does that actually look like for the operator?
You have to picture the sheer scale of the engineering. Grasberg involves incredibly complex open pit and underground block caving operations. Water management at that scale is highly complex on a good day.
You're constantly pumping water out.
Yes, to keep the working areas dry and safe. When severe, unprecedented flooding hits, it overwhelms those systems. Operations grind to an absolute halt.
I imagine safety becomes the only priority.
Entirely. You cannot move heavy machinery, you cannot safely blast rock, and your primary focus immediately shifts from extracting gold to simply stabilizing the infrastructure and ensuring the safety of your personnel.
And unlike their peers like Endeavor or Fresnillo, who have stable dry operations and are churning out cash right now, Freeport-McMoRan simply has less near-term ability to capitalize on the current market conditions. They are busy rebuilding.
They are entirely focused on recovery logistics. An 85% drop in output means they missed a massive window of elevated prices. It highlights just how vulnerable mining infrastructure is to environmental extremes.
So the market price is almost irrelevant to them right now.
Exactly. When your mine is underwater, the spot price of gold trading in London means nothing to your immediate bottom line. The physical reality of the mine dictates the financial reality of the company.
That paints a very clear picture of the divide in the mining sector right now. It is a tale of two entirely different realities.
It really is.
On one hand, you have operators with stable jurisdictions, solid infrastructure, and clear guidance capturing every penny of this price rally. On the other hand, you have massive operators completely sidelined by jurisdictional disputes and extreme weather, watching the high prices pass them by.
That's the reality of the sector.
Let's bring this all together to recap the essential takeaways for you listening. Gold has firmly regained its defensive appeal as capital seeks safety amid ongoing Middle East tensions.
Definitely.
Silver is riding that upward wave, moving in tandem with the broader market. And platinum has a clear, compelling structural narrative pushing it forward as it enters its fourth consecutive year of demand, outpacing global supply.
For the UK listener managing a portfolio, the final advice is to recognize that precious metals remain a very live, active part of the market conversation.
They aren't just sitting in a vault, gathering dust.
No, not at all. You should anticipate continued sentiment support for these assets if geopolitical tensions remain unresolved.
But expect some bumps along the way.
You must be prepared for ongoing short-term volatility, especially as macroeconomic indicators like U.S. jobs data continually reprice the strength of the dollar. Balance your expectations. Truly understand the distinct risk difference between holding physical bullion versus holding mining equities, and keep a close eye on those key markers.
It certainly requires active attention and a clear understanding of what you actually own. Before we wrap up, I want to leave you with a final thought to ponder based on everything we have covered today.
Okay.
With platinum entering its fourth year of a supply deficit and major global miners like Freeport-McMoRan and Barrick losing massive amounts of output to floods and political disputes, perhaps the true value of a mining asset going forward is not just about the volume of metal sitting in the ground.
That's a great point.
Perhaps the true premium will be placed on how insulated that ground is from the unpredictable weather and political climates existing right above it.
That is the defining challenge for the next decade of resource extraction. The best rock in the world only matters if you can consistently reach it.
Thank you for joining us for this analysis on Gold Bank. We will continue tracking these numbers and bringing you the facts as the market evolves. Take care and keep a close eye on those portfolios.